Hello everyone, good afternoon. Sage here live from the Kalkine studios and you are watching the Market Movers. Let us zoom our lens on the market performance for today. We will first look at the drivers under the spotlight, charting out the market scenario. The Australian share market opened on a weak note on Monday after the US stocks rallied in the previous session to their best week since February. And the US market ended the last week largely higher on weaker than expected inflation data and reports that US President Joe Biden has secured a bipartisan infrastructure agreement with lawmakers. And meanwhile, the local market traded weak today, mainly led by declines in travel stocks after the introduction of the coronavirus lockdown restrictions. And additionally, the tech sector rout spooked the investors. Financials, industrial and real estate sectors traded in the red. And meanwhile, consumer staples, healthcare and commodity stocks seem to be eventually pulling up the strings of the ASX 200. Local investors are concerned about a spike in coronavirus infections, with Australia's most populous city of Sydney plunging into a lockdown after a cluster of cases involving the highly contagious Delta strain ballooned. And New South Wales reported 18 locally acquired cases of COVID-19 on Monday as the state capital Sydney began the second day of a 2-week lockdown. Sydney began a 2-week lockdown on Sunday as the Bondi neighbourhood cluster of the highly infectious coronavirus Delta variant rose to 110 in Australia's largest city, while an outbreak in the northern city of Darwin prompted a hard 2-day stay-at-home order. And looking at the market psychology overall, the slightly softer than expected US inflation apparently did little to chip away investors' conviction that the Federal Reserve could tighten monetary policy if consumer price pressures continue to intensify. And having said that, among a raft of economic indicators due this week, Friday's payroll data is a key focus, with economists expecting an increase of 675,000 non-farm payrolls. And depending on the outcome of the payrolls data, the market could start pricing in more chances of a rate hike next year. And on that note, Boston Federal Reserve Bank President Eric Rosengren on Friday warned a build-up of financial stability risks linked to a low interest rate environment could lead to another downturn that interrupts the labour market recovery and impedes a return to maximum employment. Meanwhile, the general mood around an ongoing economic recovery remained solid as Republican Senate negotiators on an infrastructure deal were optimistic about a $1.2 trillion bipartisan bill after President Joe Biden withdrew his threat to veto the measure unless a separate Democratic spending plan also passes Congress. As we are discussing the overall share market movement, let us now look at the sectoral charter. To begin with, the tech sector rout is capping the overall market gains, accounting software firm Xero, cloud-based software solutions provider wisetech, and language technology data and services provider Appen dipped on the board, and additionally buy now pay later players Afterpay and Zipco traded in the red. Moving on, the travel stocks hammered as 2/5 of Australians face COVID-19 curbs. Shares of Australian travel agency companies Flight Centre Travel Group and Webjet Limited dipped as virus woes amplified. Sydney Airport Holdings also slid. And on the other hand, consumer staple stocks Woolworths, Coles Group and Endeavour Group Limited were charged up on the board. Besides, e-commerce giant Kogan and global online marketplace Redbubble also rose amid lockdown measures, bolstering the business prospects. Then the wholesale Metcash rose on share buybacks and high dividend pays. And now we'll just take a quick break, but please stay tuned. I'll be back to share today's market movers in a moment.
This is Andy Lou broadcasting from Kalkine Media Studio in Australia, and I'll be hosting the new Kalkine Wellness Show. The half-hour show will cover topics from how wellness as a concept has become even more significant during COVID, to how becoming vegan may improve your health, and much more. We are excited to showcase our live streaming show to our audience of millions overseas and in Australia. Tune in to Kalkine TV and join me.
Well, welcome back. Sage here live from the Kalkine studios, and you are watching the Market Movers. And before the break, we discussed tech, travel and consumer staple space. Now we're going to take a look at the gains in the commodity and the energy sector. The Australian energy majors such as Woodside Petroleum, Santos and AGL Energy are trading in the green after the crude oil prices rose for a fifth consecutive week. And the crude oil inched up on expectations that demand growth will outstrip supply, and after the OPEC Plus decision to be cautious in supplying more crude oil to the market from August 2021. Moving on, the heavyweight miners BHP Group, Rio Tinto and Fortescue Metals Group traded in the green amid the Chinese coke and coal, both marking an uptick. Last week, we even saw Chinese coke futures surging to the 9-year highs. And on Friday, the Chinese steel and iron ore futures inched up, while the coke and coking coal both were up around 5% on the back of solid demand at the mills and supply tightness. And while the winner of the tug of war between gaining and losing sectors will determine whether the ASX 200 will recoup the early morning losses. And on that note, next in our show, we'll take a look at some of the stock movers in detail that are under the spotlight today. And like I said before the break, wholesaler Metcash rose on share buyback and higher dividend pay. Let's look at this in detail. Well, the Australian conglomerate company Metcash jumped up on increasing its dividend following a strong increase in revenue and earnings during the 2021 financial year. And Metcash is Australia's leading wholesale distribution and marketing company with a diversified business across food, grocery, hardware and liquor sectors. And the group's underlying EBIT increased roughly 20% to $401 million, with strong volume growth and improved leverage in all pillars. The group has thereby announced a 40% increase in dividends to 17.5 cents a share after declaring a final dividend of 9.5 cents a share. Besides, Metcash has increased its ownership stake in Total Tools from 70 up to 85% for an acquisition cost of $59.4 million. The group has also increased its debt facility to Total Tools from $40 million to $65 million. Metcash said it continues to have a pathway to full ownership of Total Tools towards the end of financial year 24, with put and call arrangements in place. And now it's time for another quick break, but please stay tuned. I'll be back to share today's market movers in a moment.
Tune in to get the latest information.
Whether it's about market movements or the currency graph,
Sectoral coverage or industry news.
we cover it all on our news segments.
Be on top of the latest news
With Kalkine TV.
Hello, welcome back. Sage here, live from the Kalkine studios, and you are watching the Market Movers. Let's take a look at the trending ASX listed companies. Nanosonics remained under the spotlight today as it plans to launch the new infection prevention digital product platform. The platform Nanosonics Audit Pro is being developed for traceability, reporting and compliance. A national rollout across the United States is anticipated to commence from July 2021. And Nanosonics is an Australian infection prevention company that has successfully developed a unique automated disinfection technology. According to the company, Nanosonics Audit Pro is the result of a number of years in research and development and opens up a significant opportunity to market a unique solution that provides a digital workflow compliance management system for tracking various instruments used in medical procedures. Moving on to the next ASX listed company, construction materials provider MAAS Group Holdings touched record highs on acquisition plans and outlooks. The company announced acquisition of commercial, residential and industrial real estate properties, as well as acquisition of construction materials and tools. It also reaffirmed the EBITDA outlook for the financial year 2021 to be between 70 to 77 million Australian dollars. And the next ASX company on the list is Splitit Payments, who remained under the investors' radar on partnering with leading Middle East BNPL provider Tabby. Notably, Tabby will integrate Splitit's instalment payment platform through a white label solution to allow its merchants to offer instalments on credit cards. The integration of Splitit will also allow Tabby to expand its offerings to new merchant categories, such as those with higher average order values. And now let's take a look at the final share in today's list. Gold Road Resources dipped on production hit. The company said that it expected the gold production from its Gruyere mine to be lower than expected because of disruptions to the processing plant at the site. Consequently, production at the operations for the June quarter will be approximately 52 to 55,000 ounces. And additionally, all-in sustaining costs for the period are anticipated to be in the range of $1,675 to $1,800 an ounce due to the lower than expected gold production and additional plant maintenance. And just an update on Sydney's COVID-19 scenario. There were actually 18 locally acquired cases recorded today for Sydney, taking the total from the Bondi cluster to now 124. So hopefully all will stay safe and well and get tested if you have visited one of those hotspots. And that is all for now. Stay tuned for more live updates on Kalkine TV across the economy, markets and sectors. Sage signing off.